All right, guys, welcome back. SmartHelping.com here, and I finally completed the lending business 10-year model. I've been live streaming it for about 5 weeks. It's been intense, but it's again up there with one of the top models I've ever done. So let's just get into it. I'm going to go through each tab, what it does, all the assumptions, and how everything works. Uh, Don't forget to subscribe to the YouTube, and the link to purchase this template will be in the description box below. I'm going to price it at $75 one-time fee. So let's start with the control tab. What's defined on here? Well, the start year, the exit month if applicable. You don't have to have an exit. The name of the company, funding sources. So any debt proceeds, equity requirements. This is the total of the startup cost plus any negative uh, cash flows, the accumulation of any negative monthly cash flows. Then you've got, based on that, you can define how much of the money you need is coming from investors, the share of profits they get, the amount of cash coming from owners, and then the resulting share of them is any left over. Equity and debt percentages, distribute excess cash. I'll get into this later. I have to explain other tabs first. And then terminal value, which in a lending model, the terminal value is going to essentially be the net assets, or in this case, it's going to be the value of any loans receivable at the end of the final month of exit, less any owed debt. And then usually there's some multiple of that. I just put a 1x for this. You can account for any seller fees or any fees that are going to come off of that, and then the net amount will pull through to the cash flow, and it will reduce any debt that was exists, if at all. Next tab, loan configuration. So this is where the main meat of the model is, and this is where all of the complexity has come in. And I didn't know if I was even going to be able to build this. It was so difficult. But basically, you can plan out the lending of three different loan types. The first type is interest only, a loan with an interest only period, followed by a principal and interest repayment plan. The second type is just interest only loans. The third is principal and interest only loans. So those are the three main types that exist at a high general level. And the user can plan out the month they want to start offering these types of loans, as well as the starting loan count, and then the monthly loans originated or lent out per month in each of the 10 years. There's two possible main use cases for this. The first is obviously the lending business part of a bank, or just a lending business in general, is one type of business. The other type is somebody who's participating on like a P2P lending site, and they want to give loans out over time. And then based on some average interest rate and the average terms of the loans that they're doing and the average amount they're doing over time per loan, all of this can populate and tell you how much cash you're going to need to give those out, the amount of principal that you should be getting repaid and when, any origination fees earned, um, and I don't know if I said that principal paid back. Uh, the model is going to take any positive net cash flow from operations, which would just be the interest revenue plus origination fees minus any cost of goods sold or operating costs. If that number is greater than the net effect of lending out for the month versus what was collected, um, then there'll be a cash distribution. If it's less than that, then it means you're still operating at a cash deficit, which is fine. It just means you're growing because you're lending out more, and um, the net income will just offset the amount that needs to be the equity requirement until it gets positive. So you can see real quick if I go to the cash flow statement, and we'll get into these more. But if you just want to look here, When it actually gets positive, we got to go over. Here we finally have a situation where the net income from operations is greater than the net effect of any debt service and then any principal collected from borrowers less disbursement. So these would be loans given out, principal collected, operations. That number here is positive, so now there's a distribution. Before that, it's not. There's no distributions happening. You can see distribution of excess cash flow here. So this is really going to define all of that, those results, and the logic. If you want to see it, it's kind of crazy. There's what, 1, 2, 3, 4, 5, 6, 7 tabs, and there's over 800 rows of logic, and it's essentially putting these loans on a monthly cohort, and based on the count of loans and the average loan amount each month, it figures out the total dollar value that needs to go through all the logic, and then it will figure out based on if it's um, interest only with P&I following. It'll figure out the loan amounts, the interest for that, the principal and interest payback over time, and all the timing. Or if it's interest only, it's going to figure out the logic for that, interest collected, and when the principals were paid. Everything's offset 1 month from lending. So if you lend out X amount, the first payment of interest and or principal and interest, if it's a principal and interest only, is 1 month after the amount is lent out. And you can see here there's just a ton of logic to figure out. Like here's just the operation of the first cohort of loans, which is 10 at 50,000 each, and you can see the effects over time and when it's paid back. I think I did 10 or 5-year terms on this, but this will all adjust automatically based on what is configured here. It's really interesting logic. You can see here's like where there's an interest only period, so there's no principal paid back for the first 4 months of the loan. Um, you can see if you go to this one, PI1, you can see the borrowed amount is here, so that's the amount that the company, the lending business or lender has lent out. The age, the P&I age, which is different from the actual age of since the origination, because this is going to be used in a P&I payment and principal payment calculation of an Excel formula. The number of payments, which could change based on the term or the assumptions changing over time. PI3, so this is saying the month-end balance, um, and you can see here the first one was interest only for 4 periods. So the money was lent out here. The balance is here. 1 interest, 2, 3, 4 months of interest. And now, switch to P&I and you can see the principal going down now. So that's the most complicated part of logic. Here's the interest only payments for each cohort for that loan type configuration. And, this just follows along with each of the loan types. And there's just a whole bunch of logic here. Principal balance. This is interest only loan, so they don't have their principal balance is just the origination amount, and then it gets paid back at the end of the term, and then there's interest that's calculated based on that each month, and then the aggregate of all that happening, like adding new loans each month, is summed up here at the top, and then that flows through to the rest of the model for the aggregate summaries. So that's really the nuts and bolts of the model. Here's the default rate, which applies to any principal repayment, and this acts as essentially an expense because it's likely you're not going to have 100% repayment. Some people won't, so there's some amount of principal that's not collected, and that's accounted for here in this percentage that applies to all the loan types. Cost, this is for if you're doing an operating model and you've got to hire people to run this type of business. Obviously, the more operating costs you have, the more volume of loans you're going to need, or the higher dollar value of those loans. So support, operations. And usually the higher the loan count, the heavier the OpEx, the less the loan count, the less OpEx. And then if you do higher loan amounts, you can get some interesting things there with the scale and what it costs to service the loans and everything. So you can define different costs by month over 10 years. You can define the start month of each OpEx item. We've also got costs as a function of total monthly revenue, which this would essentially be if people are paying through credit cards and there's a credit card fee the company has to bear. You can zero out any of this if it's not applicable. You've also got cost of goods sold, basically a dollar value per active customer, and here a customer is just assumed to be a loan. So this is the cost per count of loans existing per month, and there's three types you can do there, or you could zero it all out. And then there's also a cost of goods sold section for just if you have cost of goods sold that are not directly related to anything and you just want to fill in a dollar value for each year. And note these are monthly costs per year. So cost per month in year one, cost a month per year two, etc. One-time startup cost, just fill in at the beginning in year zero, whatever that might be. It's going to affect equity requirements. And same with CapEx. This is not going to be part of EBITDA, but it's going to flow into cash flow after the EBITDA line based on the month populated and the amount. You've also got customer service reps. So here you can define each tier, you can define how many customer service reps you need to handle one customer. And you can do up to two different types of customer service people, different salaries. You start by defining, so if you did point one here, it would mean one customer service rep can handle 10 customers. And then the percentage improvement, if you put a percentage here, it just improves the amount that each one customer rep person can handle. So that's interesting. I felt you can also, for the second one, the same logic, it might have different salary amount. And then tier two, same exact logic, but for tier two loans, and then tier three. And this is based on active total loans for each tier. Sales reps works a little bit differently. It's based on the added loans per month. So the amount of reps needed per added loans per month. So it's a little bit of a different ratio. And you can define that here, the amount, the monthly improvement. This is the fully loaded salaries. And that there's also two different types of sales reps you can account for, and for each tier of loan. So that's everything to do with how revenue is calculated, cash flow, principal loans lent out, principal collected, origination fees, interest revenues, operating costs, startup costs, scaled costs. And then all of that aggregates here, and you can see a monthly detail all the way through to 10 years. All the assumptions being applied here. The first section is just loans. And actually, this isn't loans added. This is loans. This should just say loans. So you got borrowers added, borrowers paid off, ending borrower count for each type. This is all referencing the matrix tabs to figure out accurate figures. Consolidated totals, cash flow for each type, which is going to be the amount lent out per month, the principal collected back, interest earned, total outstanding loan amount, origination fees. And you can see that's for each type as well as on a consolidated basis. And then you've got type 1, 2, and 3 loan revenue. This is interest. Then this is origination fees, total revenue of all of that. You've got cost of goods sold, gross profit. Then you've got OpEx here of all the different types of cost categories, total OpEx. Then we've got EBITDA. Here's some logic for how we did the head counts for each customer service and sales rep by type and two actual types of each headcount type. So 2 sales reps per tier, 2 customer service reps per tier, 2 types. CapEx, startup costs, debt service, which is if you're taking out a loan to start this business in the first place. Debt balance of that, debt proceeds, repayment of that, terminal value, which again is going to be the net asset value times a multiple, less selling fees, less this. Then we've got our loan disbursement activity versus principal collection activity, which will be 100% based on the timing and values of the assumptions for each loan type. Cash flow before taxes. Then taxes. So for taxes, there's so many different variables that could affect it. So what I did is on the annual tab, you'll just go in and define what you think the taxes will be each year, which will be different depending on your assumptions. But it's just too complicated to try to do a formula that references something to figure this out. There is enough granularity in the logic to understand, like here in the income statement, on the annual income statement, you can see down to EBITDA, interest is broken out, taxable income here, and then the taxes. Technically, we could just take it rate times taxable income, but I just thought it was still, there's too many variables to account for. So um, on the annual detail, you'll just enter in what you think the taxes are each month, and that will affect available cash to distribute as well. So you have cash flow after taxes, cumulative cash flow, and then this value is actually going to be what is used to figure out the equity requirements. So you can see here 33,176,000 is the same as the minimum, and actually we're going to use the minimum on the monthly because that's more granular and more accurate. So if we go over here, we can see the lowest number is 33,176,685, and then that should be that number, which, yep, it is. Um, then you've got the number for the cash flow statement, which always should be the same. The ending cumulative cash here should always be the same as the cash flow statement ending number. And it is, that's good. Active months, that's going to be important for figuring out based on what is entered in the annual taxes. If it's less than a full 12-month period, then obviously the monthly taxes might be different. So that's all accounted for automatically. And then this is for some charts. We've got revenue by each loan type. Distributions is showing you the equity requirement, the usage of that equity over time, and then finally when we get positive cash flows, you can see that being distributed, and then the exit value here is taking any receivables, essentially turning that into cash, less any fees. You can see the project internal rate of return, discounted cash flow analysis, net present value, based on the discount rate. Also, based on the percentages defined, you can see the investor and owner cash flows and their discounted cash flow analysis as well. And then you can see the only reason why I wanted to add this at the bottom, this is showing cash flows from the cash flow statement, which should be identical to this item unless you go on the control tab here and put distribute excess cash to no. And if you do that, then you can see nothing is actually distributed until the exit, and at that point, any cash left in the business and the value of the receivables times multiple, less fees, less debt, is going to pull in here, and then the discounted value is goes back to here. I thought that might be kind of interesting. If we go over to executive summary, we've got the high level, two revenue types, revenue streams, interest and origination fees, total revenue, cost of goods sold. This is kind of like an income statement cash flow summary. That's kind of what I defined as the executive summary, and it's got some charts showing revenue by type and EBITDA. And you can see we also got debt service coverage on here, if applicable, all the different items for that are going to affect cash flow. And then this number 17,920 should always match the annual detail 17,920,000, which it does. Um, so this is like the high level. You can view what's going on with the operations per year for all the main line items. A lot of cool visuals. So, and I'm gonna actually put an NA on the exit for this just so you can see. So in this case, um, we've got operating activities, so revenue, gross profit, EBITDA, cash flow before equity, and so you can see the this accumulation of negative cash flow is our equity requirement, but you can see how we're slowly getting into positive territory as more principal is being collected against what's being lent out. Again, that's all going to be different depending on how you define these assumptions. It could change um, a lot, and it's really cool when you start changing things. You can really see some patterns and how things work. I think it's super cool logic. Operating costs, cost of goods sold, G&A, S&M, R&D. Then if you go here, this is pretty cool. So what I did is you've got total outstanding loans receivable versus interest earned. And I did that for each loan type as well as consolidated. And so you can see the black line is how much interest revenue is earned. The bars are what's your total loans outstanding, so loans given out less principal collected. And then based on that, you can see how your loans grow, the interest grows, and then when you level out. And these produce some very interesting curves when you start messing around with the assumptions as well. Like if let's say we start out with less loans to begin with, and actually the interesting ones are this first type of loan. So let's say we did like 1, 3 a month, 5 a month, 8, and the term was bigger, and then it starts to drop. You see, you get some really cool curves, and based on how you're doing your loans, these charts will change. I thought that was a nice way to quickly see if you change something on the assumptions, how visually, what's the effect, what's happening now over time, over the 10 years. So that's cool. This one is monthly loan disbursement versus repayment. So this is just every month, how much are you giving out or lending versus how much are you collecting in principal. And then the difference of those two plus whatever your net operating income is going to be your monthly cash flow. I guess less any debt service. So you can see this for interest only. It's a little bit more of a simple chart because there's no principal being repaid over time. It's given out, interest is collected, and then the principal is paid back. But this will change based on the assumptions as well. And then total outstanding loans receivable versus interest earned for type 3. So this is similar to type 1, except there's no interest only period, which is why you see a little bit of this is not as smooth because there's interest only periods in there, and in here there's not in the third type of loan. And then you can see the consolidated effect of everything, how much loans are outstanding and how much interest is being collected over time. And then the net effect of cash flow for each per month. You've also got year ending loan count by type, revenue from those loans by type, cumulative cash flows versus outstanding loans. So this is like what's your receivables of loans owed to you versus how much cash have you spent so far. And then essentially at the exit, you would get whatever this value is or based on the multiple. Um, so I thought that was a cool chart. The monthly cash flow. So this is again the accumulation of this loans lending activity against operating activity, and this is the net effect of that happening. And then you got headcount of customer service and sales reps, which is just based on loan counts over time and loans added per month against whatever you define the ratios as. And now you see what happens if we do a yes here, which, and don't worry, these NAs are fine because if this is no, there is no terminal value, so we're not returning anything, so there's no errors in the calculations when this is selected as no. I guess I could put an if error around it so people don't get scared. of seeing those. So we just put 0 here. If there's an error, to zero that out, that's no problem. And I always go to the balance sheet to make sure, because that's the best checker of what's going on in the model and if it's correct, which we'll get to here shortly. But if there's an exit value, let me put yes here. Or I mean, if we're distributing excess cash and there is an exit month, you can see here, there, that pops up, and essentially that tells you what this is versus the net cash flow of all the operations, which is about positive 19 million. And then you can see that just affected the operating model as well, because this is doing cash flow before equity. All right, visuals. Let's go to the income statement. We've already kind of went over it. It's just a formal income statement, month ended, based on the year and the start year and the month ended. And then this will be based on the company name. You've got origination fees, interest revenue, cost of goods sold, operating costs, and I just did the 3 here because there wasn't enough spaces in my template that I was using, which was, I have a different 3-statement model that I integrated into here, and there was no sense in relisting all of the, since they're already here. So I just aggregated each category in total and put it on the income statement in its own section. And then you've got EBITDA, interest, taxable income, taxes, net income. And then also startup costs in this case are just all included in EBITDA just for the purpose of getting, making sure the cash flow statement matches the actual cash flow that's happening, because there's no year 0 in this. It's just month 1 is January 1, and it goes forward from there. Income statement annual. Same deal, just on an annual basis. Balance sheet. This is the only reason why I really did the 3-statement models, because I wanted to see what does everything look like with cash, um, loans receivable that are being given out against long-term debt, how much equity was put in, and retained earnings. And this has got some really cool logic and puzzles here to figure out when I was building it, but it all works out. And you can see at the end, like, here's your loans receivable amount, which is going to be the exit value basis, less any debt, less any seller fees, which are defined on the control tab here in E35. And then that number equals essentially your equity plus retained earnings. So really cool. And it all works out. No matter what you put in the assumptions, this will always balance. And I tested it extensively. I put like 4 or 5 hours in it last Friday off stream to make sure all this was working correctly. And it's really awesome, the functionality here. Balance sheet, annual, same thing as a monthly, just these are the values at the end of each year. Cash flow statement is aggregating all the effects of operations, any capex, um, financing activities, which would be your equity funding, any debt funding, principal repayments, and then I put the lending activities in here as well, because I feel like that's considered financing. So that's in here. The amount of principal collected versus how much is being lent out sits on that part of the cash flow statement. Then you net everything together to get the monthly cash flow here. And then I just did a quick calculation to figure out if we wanted to see what it looks like for the cash to stay on the balance sheet. If we hit no, then it won't distribute and it'll stay in the business. Otherwise, yes, it will distribute anything in excess of the cash needed to continue lending out money. So if you had loans, if you were continually increasing the loan amount and the dollar value lent out over time, then you essentially would never see a positive cash flow month. But you would have a very big receivable amount. So you could like figure out how big you want to get. What does that look like over time? And even though you would have no positive cash flow, you can see how much equity you need to actually get that big, and it would mean you're reinvesting all of the operating income back into lending more, and then whatever's the difference is that you don't have to cover the amount you want to lend out would be going to equity requirements. Uh, so really cool, really cool, really cool. So yeah, cash flow annual, then the debt's just if there's any debt to start this whole operation, that would fall into here. And we've already been over the matrix tabs. So that's everything. I feel like the value here for $75 for this template, it's insane. I mean, I'm sure people would pay thousands of dollars to get this done and analyzed. I know the logic is super complex in principal and interest forecasting and what that looks like to come back. And the fact that we're doing it here with a bunch of assumptions around it is so valuable. I believe this is a leading template in this industry and will be highly um, used and very useful. So I'll see you on the next one. I'm going to start on probably something with inventory next week when I do my live streams, and we'll go from there.